How's it going, YouTube? In today's video, we got to talk about when does it make sense to look at buying your first property versus continuing to pay rent. We're going to look at that question from a tax deduction perspective in this video, and I'm going to give you a few guidelines and a few tips of ways you can analyze that question for yourself. My name is Mike, the CPA, and I make videos that cover business, money, accounting, and taxes. As a CPA, I work with a lot of different professionals in various industries. Industries like mortgage lending, bankers, attorneys, other accountants, financial advisors, etc., etc. And often when we're talking about real estate, a lot of people, are looking to get their first home, how they're gonna do that. They might be renting, and I will often hear, whether it's from a client or just from people in general, that it is often cheaper to buy than to rent, or it might be. So the question is that true in today's real estate environment? In today's real estate environment, we have interest rates for the 30-year mortgage is right around 7%, maybe 7.1% as we speak. And we're in the middle of 2023 when I'm producing this video. And from everybody I've been speaking to who's in the real estate industry, they're expecting interest rates to continue to rise over the next year, maybe the next several years, before we see any major pullback in rates. But nobody has a crystal ball. Nobody truly knows. So we're going to analyze that statement. Is it cheaper to buy right now or to rent? And we're going to figure out when that's true and when that's not true in the example we're going to go over here on screen. Well, when we're looking to acquire a home, we want to consider all the expense factors involved, of course. But in this particular video, we're just looking at it from a tax perspective in terms of what's our mortgage, what's our taxes and insurance, minus the tax deductions versus what is our rent. That's how we're going to look at this and the information in this video. But like I said, you want to look at also, how much do you expect to put into the property in terms of a annual maintenance basis for repairs for like your water heater. What if the air conditioner goes out? So we always have to be thinking of these other things too, because that's part of home ownership, but we're not going to be focusing on those kind of expenses. Of course, you're going to have utilities and other things as well, but we're primarily going to focus on the expenditures that relate to the mortgage, the taxes, and things like that in this video. So when I was looking to put together the information for this video and for this example, I asked myself, what is the median home price in Stanislaus County? Stanislaus County is the area I grew up in. It's in the Central Valley of California, which is basically the farm belt of California. It's about 2 hours or so from the ocean, if you're not familiar with the California landscape. But that's the area of homes we're looking at here for this example. And then I asked myself, okay, if that's the median home price, what is the average rent price right now in Stanislaus County? And we found that it is between $2,000 to $2,500 per month at this moment in time in July of 2023. For the sake of this example, we're going to look at this from the point of view of somebody who is single, a single filer for tax purposes. Let's call them Chipper, because why not? And in this example, Chipper makes about $100,000 a year. $100,000 a year is nothing to sneeze at. But we know with inflation and how it's been, it's not as much as it used to be. But if you make $100,000 a year, that means that we clear, realistically, we don't clear 100K. What do we actually take home? Well, we actually take home somewhere between like 70 to maybe 75,000 realistically, and that's after all income taxes are considered, federal and state, and the payroll taxes, Social Security, Medicare taxes, and things like that. So let's just say we're going to make around 75,000 realistically. That's what we're taking home. Now, Chipper was able to do one thing that really helped him out when he was first getting started. He actually, after landing his professional job or his highest paying job, he actually continued to live at home for a while. And when he had to move out, he just rented a 1-bedroom and lived really, really frugally. So Chipper was able to save up a down payment of 20% for this property, which that's quite a bit of money. That's on a $460,000 house. That is a $92,000 down payment to get 20%. But by getting that 20% down, then he's able to basically wipe out that PMI insurance, which would probably be about an extra $100 or so for every $100,000 borrowed. And he's able to now just pay the mortgage, the interest, property taxes, and insurance with his payments. But Chipper has an important decision to make. he has the funds to put 20% down on a property, or he can move into a bigger rental, his own apartment, his own house to rent. He's not sure if it's better to rent now or to buy. What makes more sense financially for Chipper? Let's start by analyzing the cash outlay if Chipper decides to rent. Chipper finds a property he likes in Stanislaus County. It's renting for $2,400 a month, which is no cheap rental payment whatsoever. But if we multiply that by 12, that means Chipper has to dish out in rent $28,800 a year in rental payments. Ouch. But is it better? Is that still cheaper than it would be to buy? Well, we don't know yet. From an income tax perspective, if Chipper's a single filer, makes $100,000 a year, from a federal tax perspective, he's going to owe $14,774 in federal income taxes. And since he lives in California, there's some state tax associated with that as well. So he's going to pay $5,561 in state income taxes. And if we add the payroll taxes he pays, then like I said earlier, he's probably bringing home about $75,000 a year, which is, if we do the math on that, that's about $6,000 or so a month. Let me just run it real quick. $6,250 per month. And if Chipper's bringing home that much money every month, that means a rental payment of $2,400 would be approximately 40% of his take-home pay. Okay, now let's look at this from the point of view as if Chipper decided to acquire that property instead of rent the property. What does that look like? And for some of you, this might shock you in terms of how this actually works from a tax perspective, and you might be surprised. Okay, so $460,000 property, we put $92,000 down, which means we have a mortgage that we owe now over 30 years of totaling $368,000, right? Our interest rate, 7.1%. Hopefully, in the future, we can get that refinanced. Chipper can refinance that and get that payment down a lot lower. So from an interest standpoint, and of course, we know that Chipper is going to pay the most interest in the first year when his mortgage balance is the highest, right? That means that in year one, if Chipper acquires his property, that he's going to pay in just interest alone $26,367. Now that's the potential tax deduction he can take. That's one potential deduction. From a property tax standpoint, from just averaging about 1% or so for property taxes, that means Chipper will pay $5,750 annually in property taxes. And in terms of homeowners insurance, which we all have to have, that means Chipper would pay $1,610 a year roughly in homeowners insurance. So the monthly payment, if Chipper were to buy this property, would be about $3,100. It's $3,100 a month right now versus $2,400 a month. Okay, but we don't know if it's still cheaper yet. We know it's more, but is it actually cheaper after we consider tax deductions? With $3,100 a month payments, we're looking at Chipper's looking at a cash outlay now of $37,724 per year, which is pretty substantial for somebody who's making $100,000. That's about half their income, which is more than it's probably recommended. But this is just for the sake of the example, folks. So that's what we're going with. Now that Chipper can itemize his deductions on his taxes, that gives him a lot greater tax deduction benefits, because he's now able to itemize, which means he can deduct his mortgage interest, he can deduct his property taxes and things like that. So in terms of his federal taxes now, they have been lowered. So now on his $100,000, instead of paying $14,700 something if he was to rent, he's now only paying $9,373, which is about $5,400 savings there on federal taxes. And from state taxes, it's going to save him about another $2,700 in state taxes. So the net tax savings of owning versus renting in this example is about $8,136. Now, is that net tax savings, though, is it greater than the amount of money we would dish out in rent? And when we're looking at the total cost of our monthly payment of owning versus our total monthly payment of renting, the answer is actually no. Yes, it's no, believe it or not. Remember, the annual cash outlay of renting the property, of buying the property, per year is $37,224 compared to $28,800 for renting. That's $8,424 more than in total rent versus total rental payments. And if we only have a tax deduction savings of $8,136, we're still paying more by owning. It's not that great of a deal yet. However, if rents continue to rise, which probably will, then at the point at which Chipper is paying $2,500 a month in rent or $2,600 a month in rent, then owning is starting to look a lot better. At that point, even though on paper, his payments larger, because of the tax savings he's going to acquire, it's actually going to lower his overall net cash outflow when taxes are taken into that equation. Now, when we looked at that example, did any of you think that, wow, I thought his tax savings would be a lot more, because $26,000 in interest deductions and $5,000 or $750 in property tax deductions seems like a lot. It seems like it should save him a lot of money. So why doesn't it save him more in taxes? The answer is, well, one, the filing status is important. So if you're a single filer, your standard deductions a little bit over $13,000 a year. And in fact, in 2023, it's even higher now. Now it's like, I think it's like $13,500 or $13,700. I'd have to look it up. But the point is, your standard deduction is given to you every year, no matter what, which means that of the mortgage interest and property taxes we would be paying by owning a property, we get no greater tax benefit from that until the total amount of those deductions exceed the standard deduction. Anything that exceeds our standard deduction will start to benefit us tax-wise. But that's why it's not as great of a savings as we initially might have anticipated. We thought we would have about $31,000 in deductions, but really, in terms of what we're actually getting as an additional boost to our tax deductions, is actually a lot less. So instead of getting the $30,000 boost, we're only getting like a $17,000 boost because of the standard deduction would have been given to us anyways, regardless if we owned a property or not. So that's what you have to look at, is look at the standard deduction, look at how much interest you'd be paying. For a married couple, now I know this is for a single individual, I ran the numbers. If we're looking at the same example, for a married couple to get a greater benefit by buying, they would have to be paying about $3,000 or so a month in rent, because a married couple has a standard deduction of about $26,000 or $27,000 annually. So they would not get as great of a benefit on owning a property until that rental payment got up to the $3,000 or more range. Really encourage all of you to do, if you're looking to acquire property, is look at the numbers, look at the taxes. Don't let somebody tell you that it's cheaper to own just because of tax savings. It's important it might be, it just depends. It might be, but you want to run the math to make sure that it's actually going to benefit you before you get locked into a 30-year mortgage. All right, guys, I hope this was helpful. If it was, please drop a like, share this video with others, especially people who are looking to acquire their first home. And thanks so much for watching. Be sure to subscribe, and I'll see you all in the next video.